All right, welcome back to another Tech Talk from MarketEdge.com. My name is Rachel, and with me today is David Blake, our CMT, here to discuss the recap of last week's market and what to look for this week. David, how are you today?
I'm doing well, thank you.
Great. Let's cover last week's market letter, if you don't mind.
All right, well, we had another volatile week in the market. We started out with the major averages hitting new record highs for a second straight week. And then we had investors kind of position themselves for the announcement on rates at the FOMC meeting later on in midweek. And they came off the highs on Friday, but in general, it was a very good week. In fact, the NASDAQ was on track for one of the best weeks since August for a while there until Friday. We started out, we had a couple of announcements from the White House. There were a couple of deals made with Asian countries over the weekend. I think Japan and South Korea and a couple other things like that. And then the meeting with China was back on, so that kind of boosted equities a little bit. But once again, we're back to big cap tech, the Mag 7 and AI related stocks leading this rally. It continues to be a narrow rally up, but at the end of the day, it's what the prices are. And we look at it right now, the prices keep moving higher. We had the Philadelphia Semiconductor Index sharply higher on Monday. I think that was Qualcomm announced new AI chips that were going to rival NVIDIA. That stock was up something like 10 or 11% on Monday. And then we had NVIDIA announce a deal with Palantir on Tuesday, I believe, Monday or Tuesday. And then they also did a $1 billion investment into Nokia. So the semiconductors were again on fire. They jumped 3.6%, I believe, on the week. They've been up like 5 weeks in a row, I think, something like that. But anyway, so we got to the quarter point rate cut on Wednesday, which we were expecting. That didn't surprise the market, but we did get a little bit of a hawkish comment from Fed Chair Powell. He kind of doused the flames after the meeting. He basically said that December rate cut is not a foregone conclusion. In fact, far from it. And I think one of the problems is also with the lack of data that they're going to get. They certainly don't want to be cutting rates, and all of a sudden when the data comes back out that we had a stronger November and October and maybe even December than what they thought they were going to get. So that's going to tie their hands a little bit. But we still see, I think it was about a 92% probability of a rate cut in December before the FOMC meeting. And that fell down to, I think, about a 67% probability of a rate cut. So it's still fairly high, but certainly, again, as a lot more people are moving to the sidelines saying, well, let's see what some of the data is going to be. And now with the government in the second month of having the lights out, that data, who knows when they're going to get that. So we just kind of watch on that. But without the data, you're pretty much relying on the semi rally and then the AI related stocks, which is moving things. Now, well, also we had several of the big Mag 7 companies released earnings, and early they were kind of mixed. Alphabet, the old Google, they blew numbers away, and that stock traded up 5-6%. Microsoft was mixed. They had good numbers, something with their cloud revenue may have just been off a little bit, so it was kind of flat to down. And then Meta Platforms actually missed, and they had to take, I think they had to take like a $15 billion hit for something. That stock was down about 10-11%. But then on Thursday night, we got Amazon coming out. It kind of rescued the market a little bit. And Amazon had blowout numbers also. In fact, it's up again today, I think. It was up about 4 or 5% with the XLY, the consumer discretionary sector, keeping the market up today on Monday. So a lot of stuff going on. As far as the major averages going higher, they were higher for a second week. We did get strength in technology and consumer discretionary sectors. They were the best, the strongest groups. And then the defensive sectors are lagging, which is surprising. If you're looking for the market to slow down and rates to come down, you wouldn't think that the defensive sectors would be the weakest. And that included REITs and consumer staples and utilities, and also materials were kind of weak too. Now, I noticed something else a little bit surprising in this market. Generally, when rates are coming down, you would be thinking over the last month or so that the homeowners would be a place where you'd want to be. As rates come down, you're going to think, the 30-year mortgage would certainly come down. But that doesn't seem to be happening. In fact, if we look over here, the ITB, this is the U.S. Home Construction ETF. I can see over here from about September, right here, they started to cut rates right there for the September meeting. We got a little bit of a pop. And then you can see right now it's doing nothing. And that's just the opposite of what you would expect in an environment where rates are going to continue to go lower. So I think despite what some of the talking heads are saying, I think there's some beliefs that perhaps we're going to see rates either not go down any lower or just go sideways or maybe even tick higher. They ticked higher again today. They're back up to 410 on the 10-year treasury. And I think the 30-year mortgage had gotten down to about 6.10, and it's back up to about 6.38. So that's kind of keeping the housing stocks just not doing what you would think they would do if rates are going to continue to come lower. So we'll kind of watch how that's going. As far as the technical condition of the market goes, it's kind of mixed. The reason I say that is despite the fact that we're making new highs early in the week, the gains keep coming from a narrowing group of overweighted big cap tech and AI related stocks. Well, confirming that narrow rally, there's a chart that shows of the 5,000 stocks that MarketEdge covers, we only have about 46% of those stocks above their 50-day moving average, which we tend to look at that as an intermediate trend for what the market is doing. And then on the S&P 500, but you're down to only 41% of the stocks in the S&P 500 trade above their 50-day moving average. That's a weak market, and that's a very narrow market, especially when you're making new highs. A lot of times you'll see the market making new highs, and you'll look over there, and it'll be 70% of the stocks are trading above their 50-day moving average. And that's showing a very broad-based rally. When you're getting these kind of figures, that's confirming the gains are on a narrowing group of stocks. So just keep that in mind. If you're thinking about, I'm getting left behind here, I need to catch this rally. Another sign you can look at on our MarketEdge site, if you look at this, we kind of, if you follow the opinions of the upgrades and downgrades, one of the things you'll see over here, this is when we all talked about in the summer, we've got a broad-based widening market and things are looking great. And you can see here, all those stocks were getting upgraded to buys. Not too many were getting downgraded to a sell. And then that started to roll over. There weren't a lot of them going short or on a sell side, but a lot of them were going from buys and strong buys down to a neutral rating. And then maybe some of them to an avoid. That's kind of going sideways, but you can still see that the market's going up and making new highs over here. This is what you would call negative divergence when I talk about that. This line is not confirming what you're seeing just from the index at the end of the day. So that's another red flag that we like to see. Another thing that I did mention, the technical indicators in general are still fairly bullish for the S&P 500 and the NASDAQ and maybe even the Dow. But for the small cap Russell 2000, they're basically neutral to negative. I think we're negative today on that. I saw early today, this Russell 2000 came down to the 50-day moving average. But we did come down to Russell 2000 today. It did hit the 50-day moving average and it bounced off of that. Again, we talk also about negative divergences, especially with the NASDAQ on a 7-day win streak. And here's the advanced decline like on that. As it's making new highs every day, the advanced decline line keeps going down. That's not a sign of a broad-based rally. That's showing more narrow movement than what you want to see in a market that's going to leave you behind if you don't get in. Again, now we're starting to see over here, we had more new larges here on the NYSE. 2 days last week, you had more new lows and new highs. And also on the NASDAQ, you had 2 days. Now, I wrote somewhere on there, I think for the NASDAQ, that was the first time that we've had 2 days in a row where you had more new lows and new highs, 2 days in a row, something like since April or something like that. And then for the Dow, the NYSE, I mean, it was something that back in March or April. So it's not something that we're seeing a lot of. And that's, again, another little red flag that's going to pop up. So just the fact that you get a company like Amazon or Google, where they report something and up the guidance, you're getting big spikes in these, and a big spike in Amazon, 5, 6, 7% move on those things can move the whole market because of the overweightedness on that. So kind of keep an eye on that. This week, we're going to have a lot more earnings coming out. And I don't know that we're going to have the ability with all these companies coming out to keep the market up or not for a little while. I think it's going to be choppy. Seasonally, we have historically a strong market period. But if some of these companies are worried about, pricing and stuff like that going forward, if they're lowering guidance because they think maybe we're seeing a slower economy, that's going to eventually start to weigh on the market. And I think that would be another reason for you to be a little bit cautious. So watch out with that. Negative divergence in itself, I wrote last on Friday, is not a reason to sell. Just like when a stock is overbought, that's not a reason to sell, but it is a reason to at least be aware that the risks start to go to the downside rather than the upside. If something happens where people start to need to sell, boom, then if they need to sell, then it's going to pick it up and can take the market moves too high or too low. And in this case, if we get something like margin calls, margin debt is at a new record, that can make a market pull back, 7, 8, 9% pretty quickly when things like that happen. So just be aware that under the surface, there's a lot of risky things going on that are telling you that the risk is to the downside here rather than missing out on the gains to the upside. Now, this week, again, with the government closed down, we're not going to have a lot of data to look at. It's going to be mainly based on earnings. And one of the reasons why we saw earnings or yields pick up is we had the global PMI index came out, and it actually showed a little bit of expansion. I think it was at 52. And then we had the ISM manufacturing index came out, and it was still in contraction mode. But anyway, it was around 49, I think. And we did see the 10-year yield just tick up a little bit to a 411 or something like that. I'm not sure if it was able to hold that or not. So keep an eye on that. As far as earnings this week, we have Palantir. They had better have some great numbers because that stock has just been a moonshot. We also have Advanced Micro Devices, I think, tomorrow. Arista Networks tonight, ANET. Let's see, Pfizer announces their results on Tuesday. Apple, McDonald's, Qualcomm. Let's see, Wednesday we have Airbnb, ConocoPhillips. Thursday we have KKR, Duke Energy, that type of thing. So a lot of stuff coming out. ADP is going to try to release some kind of national employment numbers on Wednesday. Now, they started this new thing last week, and it showed an increase of 30,000 new jobs in the private sector. That was coming off of a decline of 32,000 in September's. But for some reason, ADP employment numbers are always a little bit shaky. So we'll have to see whether that can move yields or not when it comes out during the week on Wednesday. So besides that, one last thing I did want to mention from the letter, and that is investor sentiment. And again, when investors get too bullish, it's another red flag. And we're starting to get closer to exuberant levels. We saw the retail bulls jump to 44%. That was their highest number since the first week of July. But the retail bears fell to their lowest number since the first week of July also. And then we had the percentage of bullish investment advisors jump to 57.7, which is usually a bearish signal. But the bearish advisors dropped all the way down to 13.1%. And that's the fewest amount of bears in that survey since March of 2024. So again, everybody's loving this market. And that means when everybody gets on one side of the trade, that's when you have some trouble because there's nobody to jump in to keep the thing going. So we're getting close to sentiment indicators getting to a point where they're going to become contrarian signals as they get more of this reaching extremes. So, a lot of signals that historically I look at, and they show up when you're near a top or a bottom. And in this case, as we're making new highs on fewer stocks and deteriorating underlying breadth, that's not a sign that you want to be jumping into this market and buying everything you want to see. In fact, some of these things, if the market's starting to roll over and you get some of these high flyers in the AI world and that kind of stuff that jump up like 10, 12% on their earnings, you may start to think about maybe trimming some of those positions off, especially if we've downgraded them on a technical basis on MarketEdge, instead of looking to buy something because they had good earnings. I think you'll get a chance here over the next couple of weeks in a choppy trading market to maybe nibble away at some stuff later on.
All right, great. Thank you so much for this. We'll keep an eye out on all of those earnings and those chances to maybe take a little bit of profit off the table. If you have questions for David or anyone else at the MarketEdge team, feel free to send us an email to support@marketedge.com. You can also leave any questions or comments in the comments section if you're on YouTube, and we'll catch you next week. Thanks, David.
All right, bye.
Bye.